Welcome to this episode of 100 Baggers Club. Today we are talking about a market where Walmart looks strong, Nike looks weak, egg prices are falling, beef prices are still high, and U.S. consumer stocks are splitting into very different paths. The U.S. consumer is easy to misunderstand if we reduce everything to one sentence. Some people say the consumer is strong. In April 2026, U.S. retail and food service sales were still up 4.9% year over year, and non-store retail sales were up 11.1%. Costco still has traffic. Walmart is still taking share. Visa and MasterCard are still collecting fees from payment volume. McDonald's system-wide sales are still huge. Other people say the consumer is weak. Real disposable income has not improved in the same way. Credit card rates are still high. Housing, transportation, food, healthcare, and debt service all take money out of the household budget before discretionary spending even begins. Lululemon is under pressure in North America. Nike is still repairing its channel. Home Depot is held back by the housing chain. Celsius is growing fast, but margin pressure is showing up underneath that growth. Constellation Brands is still dealing with weaker end-market digestion in alcohol. Both arguments have evidence, but both are incomplete. The real question is not whether the U.S. consumer is strong or weak. The real question is this: after fixed expenses, how much budget is still available for discretionary choices? The same consumer may go to Costco on the weekend and buy bulk eggs, beef, and chicken breast and pay with Visa or MasterCard. During the week, that same person may look at the value menu at McDonald's and skip the extra drink. Then, at the mall, the same person may delay buying full-price Lululemon pants or postpone replacing a sofa, buying new appliances, or renovating a kitchen. One consumer gives three different answers in front of Costco, McDonald's, and Lululemon. That is the core conflict in U.S. consumer stocks right now. Consumption has not disappeared, but many households have less discretionary budget. Money first goes to rent, car loans, food, healthcare, and credit card interest. Only after that does the household decide whether to buy a value meal, a warehouse club membership basket, bulk food, or delay a full-price piece of athletic apparel. So this episode is not about the vague question of whether Americans are still consuming. We are asking something more specific. When the budget is squeezed, which companies can capture more transactions? Which companies can only defend revenue through promotions and inventory? And which stocks have already paid too much for the future? Let's put the conclusion up front. U.S. consumer stocks are not simply a trade on consumer recovery or consumer recession. They are more like a redistribution of budgets after purchasing power has been pressured. Walmart, Costco, TJX, Ross, Visa, MasterCard, and McDonald's own high-frequency consumption, price trust, and strong cash flow positions. Lululemon, Nike, Home Depot, Celsius, Keurig Dr. Pepper, and Constellation Brands need to prove that inventory, margins, and cash flow are repairing together. Cal-Maine, Vital Farms, Tyson, and Texas Roadhouse need to be analyzed through protein cycles and normalized profit. So the real takeaway is not one ticker. It is three rules. First, a strong company is not always cheap. Second, a cheap company is not always viable. Third, total consumption is not stock market return. Cash flow, and the future already priced into the stock, are what matter. Part 1. Start with the hard constraints in the household budget. When looking at U.S. consumer stocks, do not start by asking whether a company is apparel, home improvement, restaurants, or retail. The more important question is, before discretionary spending begins, which fixed expenses have already consumed the monthly budget? The first item is housing. Rent, mortgage payments, insurance, repairs, and property taxes take a large share of the budget before anything else. High home prices, high mortgage rates, and low housing turnover make many households less willing to move and less willing to do large renovations. Homes still age, and repair demand is still there, but moving, remodeling, furnishing, and high-ticket purchases slow down. That is why Home Depot, Lowe's, and Williams-Sonoma cannot be analyzed only as consumer recovery stocks. There is a housing chain behind them. If housing transactions are not active, renovation and large home goods purchases are unlikely to fully recover. The second item is transportation. Car loans, gasoline, insurance, and repairs keep squeezing the household budget. Consumers may delay buying a new car, which helps the automotive aftermarket. But this is not a simple car price-up story. AutoZone and O'Reilly make money from replacement parts, store networks, and professional customer service. Copart makes money from total loss vehicle flow, auction services, and international buyer demand. They share some variables, but they are not the same business. The third item is food. Within food, the key variable is protein prices. Eggs, beef, and chicken all appear on the family table, in grocery baskets, in school lunches, and on fast food menus. But they are not in the same cycle right now. Egg prices have fallen from high levels. Beef is still expensive. Chicken is relatively stable. The fourth item is healthcare and debt. Healthcare spending and high credit card interest do not show up directly in the revenue line of Nike or Lululemon, but they reduce the consumer's ability to buy athletic apparel, home goods, alcohol, and restaurant meals. So the American consumer is not simply stopping consumption. The consumer is rearranging what remains after fixed expenses. Retail sales are still growing, but discretionary budget is limited. Consumers first pay the expenses that are hardest to compress. Then the remaining budget is redistributed across brands, channels, price points, and categories. Part 2. 4 types of consumers decide where the budget goes. The U.S. consumer is not one average person. It is a set of consumers with very different spending capacity. High-income consumers still have income and asset buffers. Travel, experiences, prestige beauty, and higher-end dining still have support. That is why American Express, Marriott, Hilton, Uber, Ulta, Elf, and Chipotle are tied to a stronger customer base. But high-income resilience is also the easiest thing for the market to see early, so the valuation may not be cheap. Middle-income consumers are more selective. Warehouse clubs, home repair, auto repair, and low-price, high-quality goods take a larger share of the budget. Costco, Walmart, Home Depot, Lowe's, AutoZone, and O'Reilly sit in this layer. But the middle-income consumer is also under pressure. Mortgage rates, education, healthcare, auto insurance, and big-ticket spending can push many optional purchases further out. Lower middle-income consumers are still consuming, but they depend more on price, promotions, private label, and small high-frequency purchases. Walmart, Dollar General, Dollar Tree, McDonald's, Yum, TJX, Ross, and Kroger become more relevant here. The issue is that this layer is also most exposed to credit card rates, fuel, food, and rent. Low-income consumers have the tightest cash flow. Food, fuel, rent, healthcare, and credit costs set the upper limit of spending. Value restaurants, off-price retail, and basic daily necessities still have demand, but traffic quality is more fragile. A low-valuation retailer cannot be upgraded simply because it looks cheap if cash flow has not repaired. So before deciding whether a company is worth studying, ask which consumer layer it serves. Is it creating profit from natural income growth, or is it taking share because defensive budgets are moving toward stronger channels? Part 3. Budgets are concentrating into stronger channels. When discretionary budget shrinks, consumers trust strong channels more. The strength of Walmart and Costco is not only about being cheap. They combine food, pharmacy, daily essentials, membership, e-commerce, price trust, and high-frequency consumption. They become default destinations inside the household budget. A consumer may not buy yoga pants every day, but they do buy food, tissues, medicine, and daily necessities again and again. The strength of TJX and Ross is not only about discounts either. They sit on both sides of the squeeze. On the demand side, consumers look for value. On the supply side, brands need to clear inventory. When brand inventory is mismatched, it may become a buying opportunity for off-price retailers. That is good news for TJX and Ross. But for Nike, Lululemon, Levi's, Tapestry, and other brands, it may mean margin pressure. Payment networks are another layer. Visa and MasterCard prove nominal payment volume, cross-border payment activity, and high returns on capital. But that does not mean every product unit is strong. These are high-quality businesses, but the market can also give them expensive valuations in advance. Brand companies are in a more complicated position. If a brand depends on wholesale replenishment to support revenue, but end demand is not strong, inventory comes back into the channel or onto the balance sheet. If the brand uses promotions to clear inventory, revenue may hold up for a while, but gross margin gets hurt first. If channel inventory is high, receivables slow, and gross margin falls, operating cash flow eventually fails to keep up. The true transmission chain in consumer stocks is not. Revenue grows, therefore the stock goes up. The real chain is high-frequency budget position, real end demand, gross margin, operating cash flow, free cash flow per share, and the future already required by the stock price. If one layer breaks, growth may have no investment value. Part 4. An inventory bottom is not the buying point. A cash flow inflection matters more. One of the easiest mistakes in consumer stocks is to say, inventory has bottomed, so the stock has bottomed. Inventory decline is important, but it can come from real demand recovery, reduced purchasing, promotional clearance, slower channel replenishment, or even accounting write-downs. The valuable kind of inventory repair must come with stable margins, improving operating cash flow, and recovering free cash flow per share. In this section, we do not need to memorize every company. We can divide the risk into 3 models. The first model is inventory declining, but demand has not really come back. Home Depot is a classic example. The issue is not one inventory number. The issue is that the housing chain has not fully thawed. Inventory rose about 10%, while transaction count fell 1.6%. That means average ticket can support part of revenue, but project frequency and housing activity have not truly recovered. Nike is similar. Inventory may have peaked, but brand repair cannot be judged only by inventory decline. Direct-to-consumer, wholesale, full-price sales, gross margin, and market share all matter. The second model is inventory and margin flashing warning signs at the same time. Lululemon shows this risk clearly. Inventory grew about 18%. Gross margin fell about 5.5 percentage points, and North America revenue and comparable sales still need repair. It is not a bad company, but a lower valuation cannot replace proof of full-price selling, margin, and cash flow. Celsius is a representative high-growth case. Revenue is growing quickly, but gross margin fell about 4 percentage points. When a high-growth company begins to show pressure in channel inventory, receivables, margin, and cash conversion, the market will not look only at growth. The third model is revenue still growing, while end-market digestion and channel inventory remain unclear. Keurig Dr Pepper is a mature beverage company with a split temperature inside one business. Ready-to-drink beverages are warmer, while coffee is colder. Constellation Brands also reminds us that alcohol is not automatically defensive. Beer, wine, and spirits all need to be judged by shipments, end-market depletion, and distributor inventory. So an inventory bottom is not the buying point. A cash flow inflection is more important. The real question is not whether inventory has declined. The real question is whether revenue, inventory, gross margin, operating cash flow, and free cash flow per share can improve together. Part 5. Why eggs, beef, and chicken affect so many stocks. Food prices are not just macro background. They directly shape the household grocery basket, fast food menus, restaurant margins, and upstream producer profits. This is especially true for eggs, beef, and chicken. Egg prices have fallen from very high levels. In April 2026, large egg retail prices were down more than 50% year over year, and sharply below the 2025 peak. For consumers, that is good news. Breakfast and baking baskets become less painful. For Walmart, Costco, and Kroger, lower egg prices help strengthen price trust. But for egg producers, this can become profit pressure. Cal-Maine is now in the zone worth watching, because it has scale, cash, and cash flow resilience in a lower price period. But rising inventory and ongoing flock replacement tell us not to be unconditionally optimistic. Vital Farms has fallen more sharply as a stock, but operating cash flow is negative, inventory is rising, and gross margin is falling. It looks more like a stress test name. The most important thing in the egg cycle is not that egg prices are low. It is whether low prices force supply to slow. Layer breeder flocks, pullets, table egg laying hens, farm gate prices, and producer inventory are the variables that will decide the next several quarters of profit. The stock buying point usually does not arrive on the day egg prices are lowest. It arrives when supply slows, inventory stops accumulating, and normalized free cash flow can be recalculated. Beef is a different line. Beef prices are still high, and the supply cycle is long. From retaining cows to calving to feeding to market-ready cattle, the cycle is measured in years. A surge in beef prices directly compresses restaurant-level margins for McDonald's, Chipotle, and Texas Roadhouse. If menu price increases hurt transaction count, revenue growth can still turn into profit pressure. Chicken is more stable. Broiler supply responds faster, and chicken prices behave more like a substitute protein. That is more helpful for Wingstop, Yum, and some value menu categories. Wingstop's long-term story comes from unit growth, digital ordering, and the franchise system. But in the short term, we cannot ignore pressure in U.S. same-store sales. Stable chicken cost is a positive condition, not an automatic guarantee that same-store sales or unit economics will improve. The same set of prices can point in opposite directions for different companies. Lower egg prices are good for households and supermarkets, but represent profit normalization for egg producers. High beef prices can create a price trust opportunity for grocers, but they pressure beef-heavy restaurants. Stable chicken is friendlier to value menus and chicken restaurants. Part 6. Restaurants, auto aftermarket, beauty, and travel show that consumer is not one industry. U.S. consumption is not one industry. It is a collection of budget destinations with different cycles. Restaurant stocks can be misleading if we only look at same-store sales. Same-store sales can come from traffic or from ticket. They can come from menu price or from more transactions. McDonald's has advantages in value menus, brand density, the franchise system, and scale purchasing. When discretionary budgets shrink, value meals become more attractive. But high beef prices directly compress restaurant-level margins and franchisee returns. Yum has a similar logic, but chicken and international markets make it different from McDonald's. KFC, Taco Bell, and Pizza Hut have different categories, price points, and regional exposure. Stable chicken helps part of the menu, but franchisee profit and traffic still matter. Wingstop is a high-growth restaurant example. System sales, digital, and unit expansion are all strong, but pressure in U.S. same-store sales cannot be ignored. The market gives the stock a high valuation because it believes in the unit model and long-term store potential. If same-store sales and franchisee returns cannot keep up, the valuation quickly becomes sensitive. The auto aftermarket tailwind comes from delayed vehicle replacement. When new and used cars are expensive to own, drivers postpone replacement. That extends demand for repairs, maintenance, brakes, oil, and professional parts. AutoZone and O'Reilly are strong businesses, but valuation only holds if same-store sales, commercial customer sales, inventory turns, and free cash flow remain stable together. Advance Auto Parts is not simply an industry tailwind story. It is a cash flow repair story, and it needs to prove that guidance can be delivered. Copart is related to the auto aftermarket, but it makes money from total loss vehicle flow and the auction platform, not from repair parts. Older vehicles, higher repair costs, and insurance rules can increase total loss supply. Falling used car residual values can reduce auction value per vehicle. So Copart, AutoZone, and O'Reilly are not simple same-direction trades. They are different profit positions inside the same auto life cycle. Beauty cannot be analyzed as one simple high-end consumer trade. e.l.f. is closer to the mass price band and a high-growth brand. Revenue growth and inventory control look better, but the stock still requires product launches, channel expansion, and margin delivery to continue. Ulta is an aggregation channel, and the key variables are traffic, loyalty members, and operating margin. Estee Lauder faces a slower repair path than high-end beauty, travel retail, and the China-linked chain. A one-quarter rebound cannot be treated as a trend reversal by itself. Travel services also need to be separated by capital model. Marriott and Hilton are closer to asset-light hotel platforms, and their profit quality is different from airlines. Uber is now more like a mobility platform cash flow story. Delta may look cheap, but it still carries exposure to fuel prices, capacity fares, and the economic cycle. Middle and high-income service spending can be resilient, but that does not mean every travel stock deserves the same valuation. At this point, we have broken U.S. consumption into three layers. First, household budgets are squeezed by fixed expenses. Second, the remaining budget moves toward strong channels, price certainty, and high-frequency necessities. Third, stock returns are not ultimately about revenue. They are about gross margin, cash flow, and the price already being paid. Part 7, where the market is most likely to be wrong. Now let's come back to stock pricing. The market is not completely wrong about U.S. consumption. It knows that Walmart, Costco, Visa, MasterCard, and McDonald's are good companies, so it gives them high valuations. It also knows that Lululemon, Nike, Home Depot, Celsius, Keurig Dr. Pepper, and Constellation brands have risks, so it gives them discounts. The real issue is that the market often amplifies a structure too far. A first mistake is paying too much for the certainty of good companies. Walmart, Costco, Visa, MasterCard, and McDonald's are very high-quality businesses. But if the free cash flow yield is too low, the stock is asking for many years of near-perfect execution. High business quality does not automatically mean today's price leaves enough return for investors. The second mistake is extrapolating bad news too far in riskier companies. Lululemon, Williams-Sonoma, Home Depot, Keurig Dr. Pepper, and Constellation brands are not worthless. But they must show revenue, inventory, gross margin, and operating cash flow improving together before moving from the watch list into the capital boundary. The third mistake is extrapolating high growth in a straight line. Celsius must prove channel inventory and gross margin are healthy. Wingstop must prove that beyond unit growth, same-store sales and unit economics are not deteriorating. e.l.f. must keep proving that growth is not coming at the expense of inventory quality or channel quality. The fourth mistake is treating cyclical profit as long-term profit. Cal-Maine and Vital Farms need to be valued against normalized egg prices, flocks, inventory, and free cash flow. Tyson and Pilgrim's Pride depend on beef, chicken, and processed food margins. Texas Roadhouse and Chipotle can have restaurant-level margins compressed by beef prices, unless menu price and traffic offset the cost pressure. Quality, price, and odds are three different things. Part 8. 3 types of companies. 3 ways to handle them. There are many companies, but the handling can be divided into 3 groups. The first group is good companies, where you wait for price. Walmart, Costco, Visa, MasterCard, McDonald's, TJX, and Ross usually do not need to prove that they are good companies. What they need to prove is whether the price still leaves enough return. Walmart and Costco occupy high-frequency household budget. Visa and MasterCard are payment networks. McDonald's owns value dining frequency. TJX and Ross are off-price channels. Their common traits are strong business position, high cash flow quality, and strong market recognition. That is exactly the problem. The market already knows they are good. Buying them is not discovering a secret. It is paying for certainty. So if the free cash flow yield is too low, new capital should be disciplined. The second group is bad expectations, where you wait for data. Home Depot, Williams-Sonoma, Lululemon, Nike, Keurig Dr. Pepper, and Constellation brands are not without upside. Their problem is that the bad news has not yet been fully disproven by data. The housing chain has not fully thawed, so home-related stocks cannot be bought simply as recovery names. Athletic apparel inventory decline does not mean brand repair is complete. Low multiples in beverages and alcohol cannot replace proof of end-market digestion, margin, and cash flow. The rule here is simple. Do not buy the stock just because it has fallen. Buy only when repair is being delivered. The third group is strong stories where you wait for cash flow. Celsius, Wingstop, Cal-Maine, and Vital Farms all have stories. Celsius has growth. Wingstop has unit expansion. Cal-Maine and Vital Farms have the egg cycle. But a story cannot go directly into a position. Celsius needs to prove channel inventory and margin. Wingstop needs to prove same-store sales, average unit volume, and franchisee return. Cal-Maine and Vital Farms need to prove that after egg prices normalize, inventory, flocks, and free cash flow can hold up. Part 9. Do not repeatedly bet on the same risk. There is another issue that is easy to miss. Consumer stocks may look diversified on the surface, while actually betting on the same underlying risk. Home Depot, Lowe's, Williams-Sonoma, RH, and Floor & Decor are all tied to the housing chain. They look like different companies, but the underlying factor is housing activity and big-ticket consumption. Lululemon, Nike, On, and Deckers are all tied to athletic apparel, full-price selling, and the inventory cycle. The brands are different, but all of them need to prove that consumers are willing to pay full price again. Celsius, Keurig Dr Pepper, and Constellation brands all depend on channel inventory, unit volume, and gross margin. Beverages, coffee, and alcohol are different, but all of them face the risk that revenue does not turn into cash. Cal-Maine, Vital Farms, Tyson, Wingstop, and Texas Roadhouse are all exposed to protein prices. Eggs, beef, and chicken move in different directions, but they are still on the same food cost table. So capital cannot simply buy every story once. It may look diversified, while in reality it is betting on the same consumer, the same inventory cycle, or the same food cost pressure. Part 10. What would overturn this view? The top investment view must be falsifiable. This U.S. consumer stock framework cannot only talk about supporting evidence, it must also explain what would make the conclusion worse. First, if real purchasing power improves for several consecutive periods, low-income credit pressure falls, and the housing chain becomes active again, discretionary consumption and home-related repair would recover faster. In that case, Home Depot, Lowe's, Williams-Sonoma, Lululemon, and Nike would have a higher probability of repair. Second, if value channel traffic weakens and Walmart, Costco, TJX, and Ross no longer show stable comps, inventory, and cash flow, then the thesis of budgets concentrating into strong channels should be downgraded. That would suggest consumers are not making defensive choices. They may simply be cutting back overall. Third, if inventory declines but gross margin and operating cash flow do not follow, the repair is fake. Lululemon, Nike, Celsius, Keurig Dr Pepper, Constellation brands, Home Depot, and Williams-Sonoma would remain in the watch zone. Fourth, if good company valuations keep expanding while free cash flow per share does not catch up, even good companies can become low-return assets. For companies like Walmart, Costco, Visa, MasterCard, and McDonald's, the biggest risk is not that the business suddenly becomes bad. It is that the price has already paid for too much of the future. Fifth, if egg prices rebound because of a new supply shock, rather than a healthy repair after supply has cleared, Cal-Maine and Vital Farms cannot be automatically upgraded. Price rebound, profit repair, and stock market odds are three different things. Conclusion. The opportunity in U.S. consumer stocks is in dispersion, not total demand. U.S. consumption has not collapsed. Consumers are still spending. Retail totals still have nominal growth. Value channels, warehouse clubs, e-commerce, payment networks, and value dining still have resilience. But the American consumer has less discretionary budget. Housing, transportation, food, healthcare, and high credit card rates take budget first. Only the remaining budget flows into apparel, home goods, beverages, alcohol, hotels, beauty, and restaurants. So U.S. consumer stocks cannot be bought as one temperature. Walmart, Costco, TJX, and Ross benefit from defensive budgets concentrating into strong channels. Visa and MasterCard are payment networks tied to nominal transactions and high returns. McDonald's, Yum, and Wingstop have frequency advantages at lower price points. But rising protein costs can compress store-level profit. If menu price hurts transaction count, system sales growth does not automatically become shareholder return. Home Depot, Williams-Sonoma, Lululemon, Nike, Celsius, Keurig Dr Pepper, and Constellation brands need to prove that inventory, margins, and cash flow are repairing together. Cal-Maine and Vital Farms need to be analyzed through the egg cycle, flock data, inventory, and normalized free cash flow, not through profits earned during high egg prices. AutoZone, O'Reilly, and Copart need to be separated into vehicle age, repair demand, residual values, and insurance total loss dynamics. They should not be written as one simple, same-direction trade. In the end, there are only 3 sentences to remember. First, U.S. consumption has not collapsed, but many households' discretionary budgets have been compressed. Second, the opportunity in consumer stocks is not in betting on total demand. It is in finding who can turn budget pressure into share, margin, and cash flow. Third, a good company, a cheap company, and a good investment are 3 different things. For good companies, wait for price. For cheap companies, wait for data. For cyclical companies, wait for normalized cash flow. So the most important question in U.S. consumer stocks is not whether Americans will keep spending money. It is who can still turn revenue into free cash flow per share when purchasing power is under pressure. That is it for this episode. If you found it useful, please like, share, and subscribe. The full long-form report, company tables, and data notes are available on the 100 Baggers Club website.